Hello, everybody. My name is Jackson Pineau. I am your Director of Public Affairs here at Minneapolis Area Realtors, and I am here to give you your first housing market update of 2025. Exciting times for joining MAR, getting back into the real estate business, and really just kicking off the year. Let's start off right with getting an understanding of how we finished 2024. Quick agenda for you on this video. We're going to recap 2024's housing market. I'm going to be sharing with you some takeaway information, and we're also going to touch a bit on the larger economy and what that could mean for you, your business, your clients. But first, I want to say welcome to Gavin Mikulski, our new research analyst here at MAR. Gavin is joining us at a time where we are re-envisioning the research team, and him and I are curious, you people watching on YouTube, what do you want to see from our dynamic duo? We want to know your thoughts. We want to know what questions you have about the market, what info you and your clients need in order for them to be informed, for you to do your business. How do you want to get that info? Do you want to see videos like this? Do you want more short form content? Do you want to be engaging with the data directly? We want to know what the right path forward is for you so that way we can fit your needs best. It's part of the service that we want to make sure that you know is available to you as a member of MAR. So please take that time, jump into the comments, get to know me and Gavin a little bit more on YouTube. As always, you can reach out to us at the research@mplsrealtor.com email. That's going to be at the end of these slides. Don't worry, we'll make sure that you have them. Without any further ado, let's jump into the content, starting with a note that our website is going to be changing. The content is still there. Things like InfoSparks, things like local market updates, fast stats, your foreclosure reports, your annual reports, all of that. Your sortable statistics is still going to be there. It just means that our website is being updated. It's more of like a refurbished look rather than a complete overhaul. Keep that in mind. The information's still there. We're still there to support you. Let's jump into that 2024 housing market data. And you notice here that I'm saying we're comparing year to year. Normally, when we have these monthly housing market webinars, we're looking at monthly data, right? Now, at the start of the year, we want to make sure that we're showing you something at a bigger scale. Normally, the data that you see looks like this. This is just an example for you, the historical average of closed sales. And as you can see, the season of winter and fall tends to be a little bit slower than spring and summer, right? There's like a bell curve, if you will, here in that orange arc. And that is something we talk about on a regular basis here, the seasonality of this industry, right? Now, imagine, if you will, when we look at the annual report, like what we're going to be doing with the rest of these slides, we're not taking into account that seasonal arc. We're going to bring it up in a minute just to make sure that you know something that is most recently important. But I want you to be aware that normally we're talking about this arc, but today we're going to be cobbling together all that information from January to December, looking at annual closed sales, annual listings, and so on. Let's jump into that first one right there, annual closed sales. So, orienting ourselves with what the charts are going to look like here today, we're looking at the past 7 years, 2018 through 2024. 2024 is completed now, right? And that's why we're comparing them to the most recent 7 years, making sure you have that understanding. We're trying to break it up into three phases. I chose this time frame because we have a kind of like a pre-pandemic time, highlighted here, 2018, 2019. We have a post-pandemic of 23, 24. And then we have the height of the COVID-19 pandemic years, 2021 and 22. That's the reason why we set this scope so that way you can see the shift that our housing market, our entire economy has had in that time frame. Pre-pandemic, we had usually an annual closed sales count of around 60,000. We inflated that with 2020 and 2021, and then we had those corrective actions we've been talking about for years now by the Federal Reserve, and we are now establishing ourselves so far a 2-year trend of the mid 40,000 homes that were closed here in the Twin Cities. 45,000 homes were closed on in 2024. That's up almost 2% from last year, but it is a far cry from what we were at pre-2020. Now, we'll keep that in mind that at the whole, we're not quite back where we were. It's possible in the long run we will return back to there. But I want to dive into InfoSparks really quick to show you something that I do find interesting. Here's that same dip that you're seeing, right? Now, if you look at the monthly view just for this one moment, you see that seasonal bell curve, that peak and the trough, the peak and the trough. And the the point I'm trying to make in all of the seasonality talk right here is look at the low point of December 2024. Now, yeah, we ended the year lower than we did in November, October, September. That's part of the seasonal trend, right? 3,000 homes were closed in the month of December. But look at this presumed trough that is going to rebound again because of seasonality, right? And the return that we have gotten from the last trough, the bottom of the market, so to speak, at the winter between 23 and 24. Same thing between 22 and 23. Uh, this winter has been so far more productive. There's been more demand. We're up almost 15% in this December's closed sales compared to last December's closed sales. That is a rosy picture. I'm not saying we're fully out of the woods yet, but I want you to keep that in mind for you and your clients. Moving on into a conversation we've had about new listings. Same orientation here. We've seen a point of stability 2018 through 2021, about 75, 76,000 homes being put on the marketplace throughout an entire year. And we did lose some of that, down 10% in 22 and another 12% in 23. Last year, we regained 8%, back up to 64,500 for the year total in 2024 of people listing their homes. They're returning, they're a little bit more willing to put their home back on the marketplace, even though we aren't quite up to the trend that we were pre-pandemic, right? What are the takeaways here when we're talking about buying and selling for you? One, that first visual that we're seeing right here, the visual difference, that drop off from our pre-pandemic equilibrium is not nearly as noticed on the seller side for new listings as it is in the drop off for closed sales in the buyer side. Keep that difference in mind. That means for your buyers, yes, there is less competition. There are fewer buyers out there, but keep in mind there's also been some proportional decline in listings. There are fewer homes that are on the marketplace because of it. Uh, Seller's side, demand has softened, and it is likely to stay conservative in 2025, as we saw from that closed sales outlook at the annual level. But what I just showed you on InfoSparks should be more promising. There is improvement in this set of winter months compared to the last two winters that we had. Set that context appropriately for your clients when they are selling. The market is better this winter than it was last winter, and that's something that we should recognize as a point of recovery. Enough about the absolute countables. Let's take a look at dollars. Median annual sales. This is taking all homes that were sold. What is the midpoint of those home sale prices, right? 2024, we had a median sales price of all homes sold in that year, $380,000, and that is up 3% from where we were last year. Keep in mind, this, unlike the blue charts that I was just showing you, where a point of equilibrium, a point of stability was kind of a horizontal line, right? In this context, we're actually talking more about a diagonal line. We want a predictable diagonal increase. That's the whole reason why people invest in real estate, right? They want to see predictable, stable annual growth. And we are receiving that. Well, that's something that we are experiencing here. But take a look at the year-over-year increases from one year to another. From a 5.5% increase to 8, 9, 12% increase. This was a really steep increase from 2020 to 2021 and continues a little bit more into 2022. Then from 2022 on, we saw the impact of the Federal Reserve, right? And there was less of an increase than we normally see. This is like a marginal gain, a diminishing return, if you will. That's part of that corrective action that we were seeing from mortgage rates increasing. Fewer people willing to buy homes because their dollar doesn't stretch as far as it used to. And yes, we are returning a little bit more back to 3% year over year increase, but it's going to take time. There is recovery that is needed in this space because of the economic boom that was 2021. Switching out of median sales price and into, talking dollars in negotiations, there's a striking change that has happened in the last few years that shows pre-pandemic, uh, you know, out of all homes that were sold, what percentage of those sales got what they received, uh, what percentage of that listing price was received at sale. And on the average, this is an average statistic here, that homes got about, no, sellers got about what they asked for prior to the pandemic, let's say 99%, so to speak. And then once inflation really took off, half of all homes were getting a bit above what they asked for. I know there are some stories out there of well above 2% over asking price, right? But this is at the median. This shows that there wasn't much negotiating happening in 21 and 22. Since then, because of those mortgage rate increases and less buyers being willing to enter into the marketplace, we've returned back to a point where negotiating is back on the table in 2024 at just about where we were pre-pandemic years. So, takeaways I want you to have for you and your clients from the buyer's side, price growth has slowed, but that was an intentional slowing in order to uh, take into account that run-on inflation in 21 and 22, right? Price is likely to return, the price gain is likely to return back to that historic pace of about 6% per year. Sunny side, negotiations are back. Now, on the seller side, we need to acknowledge the fact that yes, negotiations are back, and we're not going to, on average, be getting offers over asking price, on the whole. sunny side for the sellers that we are returning to normal annual price growth, something that is foundational to investment in real estate, right? Shifting over to another metric that I think is very valuable that isn't necessarily about dollars or about absolute numbers counted, right? But about the shelf life of a home when it is on the marketplace. The longer a home languishes on the marketplace is an indicator of how slow the market is. And the faster someone signs that purchase agreement and says, "Oh, I'm interested in this home," that's an indicator of how much demand there is in the marketplace, right? Annual days on market, this is cumulative days on market, is a great way to show that relationship. Pre-pandemic, half of all homes sold in about 20, 23 days. And then you can see that sudden drop off during the pandemic. We saw it half of all homes were sold in 11 days, less than 2 weeks to sell homes. I'm sure some of you remember that fondly, but it was pretty crazy, right? The market has slowed. We are back to a point of equilibrium, maybe, where the market is selling half of that inventory if they close or if they sign contracts rather in 22, 23 days, right? Now, something I want to just have you noodle on here for a little bit. Gavin and I were talking about this earlier this week in preparation for this webinar, and we talked about the relationship on some of these charts. I'm going to bring back in the annual closed sales chart, where we said, if you remember, that we were potentially establishing a new equilibrium in 23 and 24. Those 45,000 homes that were sold throughout those respective years. And these two charts together tell a very interesting story. One of two options. One, the pace of the market has returned back to the pace that we were pre-pandemic. And if the pace of the market is determining the demand, then we know that 45,000 sales a year might be our new equilibrium, at least in the short term. A potential look into the crystal ball for 2025. We're trying, right? Um, the other way is that sales themselves are the independent thing that's really driving the speed of the market here, and that we may return back up to more homes sold, but at the cost of a slower market, right? People will be taking more time to make those decisions because they might have the money to sell, but they need more time to make sure it's the right house. They're making the best offer that they can because, as we'll show later in this presentation, the mortgage rates are still up at around 6%. They're not where they were pre-pandemic, in 4% range, right? So nothing concrete on this yet. I just want you to keep this in mind as we venture into 2025, the relationship between these two types of metrics. Moving into inventory, another very interesting topic here. We have rebounded, so to speak, from a very small inventory, 5,000 homes on the marketplace at the end of 2021, to 6,000s, high 6,000s at the end of these respective 3 years, 22, 23, 24. We are down 1.5-ish% from where we were last year, a slightly smaller inventory of 6,800 homes at the end of the year, but we are not quite where we were pre-pandemic inventory of high 8,000s. Now, again, this is just a snapshot of the final hours of these respective years. It's a snapshot. It's not a full measurement of all homes available throughout the entirety of the year, but it does give us reason to acknowledge something. You are seeing a decrease in inventory between 24 and 2018, right? But if you take into account that softening of buyer activity, that decline, the cooling, if you will, of buyer activity, we're actually about where we were because there is an equal amount, an equal ratio of buyers to sellers in 2024 as there was in 2018, which is why both of them have 1.8 month supply of inventory. Now, this may sound like we, again, are back at something that seems fair and balanced, but let's scale back out. And this is going to be the one chart where we are scaling back out and looking at a 15-ish year span and recognizing the reality that we've been in for over a decade now. 1, 2 months supply of inventory is not a balanced market. The blue line that I just drew across the screen is the minimum threshold of what I would consider to be a balanced market. And we have not seen that in the course of a given year since 2011. And this is an ongoing soapbox for those long time listeners of this webinar that you guys know we say this month in and month out. We are in a housing crisis. We are in a housing shortage, and this is almost existentially permanent leverage that sellers have in a generation-long seller's market. So again, just because we're back up to where we were pre-pandemic doesn't mean we're quite at the level of inventory where we need to have a healthy and balanced housing supply for the amount of demand that we have in the Twin Cities. Takeaways from this: buyers, observe our new market speed. Take a look at what I was talking about between the relationship of days on market and demand. That might key into some opportunities for you and your clients in being able to predict which way the prevailing winds are going, so to speak, in our market. And remember, a slower market means more time to make the right decision. Sellers, it might take longer for you to sell your home than it did in the past couple of years, especially if that relationship between demand and days on market leads to slower market times slightly for the time being, right? Set expectations appropriately when you're working with your selling clients. Now, a slower market is relative, right? Because we are still in a strong seller's market. Just because we aren't at the fever pitch that was 2021 and 2022 doesn't mean that your home is truly going to be languishing out there on the marketplace. It's still going to take, at median, depending on what type of property you're trying to sell, 3 weeks to get an offer that you might entertain to sign. So, all things considered, it's not doom and gloom for the sellers. Let's take a look at the larger economy. We got, I don't know, probably 20 minutes left, and making sure that you guys have that larger perspective of what's going on, both in the Twin Cities, but also nationally. Starting with numbers that I know you guys all really want to pay attention to on a regular basis. The Federal Reserve in St. Louis gives us the the 30-year fixed rate mortgage average in the United States. This is across the entire country. They update this every 4 days, and they are telling us right now that we have seen the return of about 7% interest rates. Some of you might be grumbling about this, and I can completely relate to you. We saw this trend. Let's just highlight it here. We saw this downwards trend here and we thought to ourselves, wait a minute, this was the entire point. We wanted to slow the economy. We wanted to use tools like making it harder to loan out money, or not harder, but less enticing to loan out money. So that way people would think twice before spending large capital to purchase goods and services like a home. And that would help fix our economy. We would get inflation under control. We could go back to business as normal, right? Yes. And for the most part, that has happened. The reason why we are returning back up Long story short, has to have to do with 10-year treasury bonds. But essentially, we are showing that the average American is still willing to spend money even under more strict market conditions. They're making their spending habits work even though their dollar isn't stretching as far. The economy is strong, it's resilient, and the market will bear a 7% interest rate. And because the market will bear a 7% interest rate for the time being, we have seen that return. And let's also keep in mind here that that 7% interest rate, although a sharp spike from where we were in 2020 and 2021, is about where we were, what, 2006, 2007, pre-recession of 2008 and 2009, right? Um, I'm not saying it's going to stay like this forever. I'm just telling you that the historical average is about 7%. So, although it feels painfully slow right now, this is part of that course correction. And I'm happy to report that our good friends over at Keeping Current Matters has done a fantastic job of showing us mortgage rate projections for the coming year. Fannie Mae is probably the most optimistic, and Wells Fargo and MBA are a little bit more pessimistic. But the average of these three major entities are telling us that most likely interest rates are going to continue moderately to decrease. And that's good news for buying clients. But keep in mind that what we were looking at earlier is home prices are still increasing. They never realistically decreased, right? And we have more reason to believe that home prices are going to increase more than what they have in the last year or two. And you need to do that calculation with your buying client to say, hey, are home prices, the gain in home prices, going to outpace what you might save in a lower interest rate? Fannie Mae has done some of that work for us, and there's a long running measurement that they have of US home prices. Keep in mind, these are national averages. Our averages here in the Twin Cities are a little bit slower. But let's dive into this interesting part of the chart where we get dotted lines that's predicting three possible avenues that might happen. Panel wide data, the dark blue one, the pessimistic quartile in orange, the optimistic quartile in teal. Don't worry, I got a zoomed in version for you. Um, for 2025, that most pessimistic quartile is calculating that the average home price is going to gain around 6%. Now, again, that's nationwide. We're including things like New York, Florida, California. That is, higher growth in home price than we normally see. I would expect us to be more about closer to what the panelists average was at the end of the year, a more conservative but still positive 3.8% increase in the next year, and a similar increase in the following year. We know this because when we're looking at our own year over year change in median sales price, this is back to the Twin Cities here. This is North Star MLS data. We can see that we are returning back to about 4% increase year over year for any given month that we look at. And you can see the most recently completed month here in December, we were up 4% from where we were this time last year. We only ever really had 1, 2 months of negative price growth, price loss in home values, right? And again, that's a counteraction from these years in beige of run-on inflation because of the pandemic. So we are likely to see a stable yet modest increase in home prices that may outpace those savings that you would get in interest rates because they're likely, from what we're seeing from larger financial entities, to decrease, but less than a percentage point, right? I want to give you some context that isn't necessarily housing adjacent, more business oriented, because you are working in a wider economy and you deserve to be fully informed about what's going on here. Luckily, the Federal Reserve Bank of Minneapolis gave a presentation earlier this week that gives us a good understanding of market performance here in the Twin Cities and larger Minnesota, the ninth district overall, but the most of the respondents of this survey come from and around the Twin Cities. And you can see here that profits in yellow and their business sales in navy blue have been down below that dotted line in gray for sales since the summer of 2024, and profits is yes for the past 2 years, but we are starting the beginning of an upswing, and the great people over at Minneapolis Federal Reserve are projecting a positive upswing. So there is some reason for optimism in both these regards. Why is that the case? It does have some to do with prices and profits. Now, take this perspective from the buyer side here. We all kind of felt these moments here in November of 23 to May of 24, where um, the goods and services that we were uh, receiving or that we were purchasing seemed to cost a little bit more time and time again for people who were working hourly and contract jobs, wage earners. They were also getting wage increases as well, right? And it does make cost of living go up when you are seeing those sales prices, especially here locally. This is that answer that you're seeing right there. Those have trickled down. We're still seeing prices increase, but the rate at which that those prices are increasing is not the same of what we were seeing earlier in 2024. So, final point here, well, two, actually, I have two more slides from you for the Minneapolis Federal Reserve. Employment, hiring has decreased and headcount has decreased in recent months, right? Businesses are feeling those pressures. They're choosing to, not necessarily lose staff, but if they end up having someone leave, go to a different job, then they might leave that position open. They may not refill that position. One or the other are very possible here, and it's staying around the marginal point of zero, but it is looking like it is starting to trend back up again. Now, with all this in mind, one of the final questions that they do have is a survey around business optimism. These are your own business colleagues, so to speak, in various industries across the Twin Cities here. And prospect for people's own businesses, uh, over 50%, almost 60% are optimistic, and another, let's say, 15% are neutral. That's pretty good. I mean, given the economic conditions we were just talking about. Now, in the community's economy, again, these are perceptions. We're still talking over 50% optimistic and another 15% neutral. The state's economy for Minnesota in particular, we're still seeing, again, with optimistic and neutral, we are still seeing a majority. And then the national economy is obviously the most pessimistic. The less you are directly engaged, the more pessimistic you end up viewing the state of those respective economies, right? I'm seeing some promise here for people's own businesses, right? That's something that I imagine some of you might see in your own business. So if you do, you're not alone. There are others that do see this potential upswing in 2025. Final notes from me about the economy, bringing it back to you for housing related takeaways for you and your client. Housing price growth is likely outpacing any mortgage rate decrease. Keep that in mind when you're talking with buyers who say, "Hey, I really want to wait for interest rates to go down before I buy a home." That may work for them. Look at their numbers, make sure that that's the right choice for them. But if they're window shopping and they want to really make sure they're making the best decision for themselves and be serious about this, you may be waiting a while to get that rate that they're really happy with, and prices will continue to increase. And you may not be getting that deal that you really think that you want now, ever in the future. Most projections show rates will stick above 6%. So the imagination of us returning back to 4% anytime soon is just not realistic for buyers. Sellers, market conditions are stable. We are seeing positive price growth. We are seeing optimism in the larger economy here in the Twin Cities. There is uh, I'm I'm sure there is caution still for people to put their home back up into the marketplace, namely because of mortgage rates. But the final question I have for those clients of yours are you married to your current rate? Or is there reason enough for you to want to sell your home? Have those conversations with them, set their expectations appropriately. We are beginning to understand what this new market economy post-pandemic looks like now, and we have more information than we ever had before. I want to make sure that you guys are able to share that with your clients so that way you are the expert that they're looking for when they're making these big financial decisions. If this presentation didn't give you enough and you need more clarity, please reach out to me. Uh, Gavin and I both look at this email research at mplsrealtor.com. We're happy to respond to anything that you need. And as always, we're here for you. Um, Enjoy the beginnings of 2025, and we will see you next time. And speaking of next time, for those of you stuck on for the remainder of this, we are shifting into a quarterly webinar model. We've realized that we can better serve you, provide a better product in these webinars, provide more insight through a quarterly model than with a monthly model. So we are not going to be presenting in February or March. We're still going to be available. We're still going to be willing to come out to you if you want to have us out and present to either brokerage offices, your teams, or hop on the phone with you, chat with you via email, and make sure that you continue to have the level of service and really save these big presentations for the quarterly recaps that we hope that you will appreciate coming to you in April. Until then, thank you so much and happy 2025.